Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Apple stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Apple is a technology company. Its specialty is in consumer electronics, software, and online services. It is the largest information technology company by revenue, the world's second most valuable company, the fourth largest personal computer vendor by unit sales, and the second largest mobile phone manufacturer. The company is headquartered in Cupertino, California, and was founded in 1976. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Xetra, Vienna, EuroTLX, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Ukraine, Colombia, Santiago, Kazakhstan, Lima, and Neo Stock Exchange. Let's get started with the model. This is a large cap company, 2.2 trillion market cap. They're trading at $138 a share, and they have 16.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. It's amazing when you look at it, they went from 60 billion to over 100 billion of free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also grows each year from 55 billion to over 100 billion. Revenue is the sales for the company, and that went from 260 billion to 386 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's highest in the trailing 12 months at 167 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. That also peaked in trailing 12 months at close to 120 billion. When you take the total interest they received on their investments minus the interest they paid on their debt, that comes at the positive $6 million. Even though they have a lot of debt, they receive more interest on their investments because they have a ton of cash and short-term investments on their balance sheet. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is over 100 billion in the trailing 12 months. This is their income statement from the latest 10Q. And this shows us the 6 months ending March 2021 and 2022, and the 3 months ending March 2021 and March 2022. Their revenue in the first 3 months of this year are $97 billion, 77 billion from products, 20 billion from services. About half that revenue is from iPhone, 51 billion, 10 billion from Macs, 7.6 billion from iPads. Wearables, home and accessories is 8.8 billion, and 20 billion from services. The only category that decreased quarter over quarter is iPad. That went down 2%. Their cost of revenue is 55 billion, so their gross margin is 42 billion. They spend 6.4 billion in R&D and 6.2 billion in SG&A. So their operating expenses are 12.6 billion. Their operating income is 30 billion. Net income of 25 billion. So their earnings per share are up from $1.41 in the first quarter of 2021 compared to $1.54 in the first quarter of 2022. Not only did their net income increase, their shares outstanding decreased. Their shares outstanding in 2021 was 16.8 billion. Now it's 16.3 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And that was highest ever in the trailing 12 months at 106 billion. They do pay a small dividend, but most of their free cash flow is used to buy back stock. They bought back $86 billion in the trailing 12 months, $72 billion in 2020, and $67 billion in 2019. When a company buys back its own common stock, it decreases the shares outstanding and makes your shares more valuable. This is the operating section of their statement of cash flows, and the way you calculate operating cash flow, you start with your net income that was $60 billion. Then you have to add back the non-cash items on the income statement, depreciation of $5.4 billion, stock-based compensation of $4.5 billion, and then you have to adjust for changes in working capital. Even though they reported an accounting profit of $60 billion, they actually generated $75 billion of cash flow. This is the company's revenue and operating cash flow since 2015. Their revenue was steadily growing from 2015 to 2021. But they made a huge leap in revenue in 2021. It went up a ton. Their operating cash flow grew slightly from 2015 to 2022. This is the investing and financing sections on their statement of cash flows. The top three numbers are purchases and sales of marketable securities. These are short-term liquid investments, and they spent $5.3 billion in PP&E, $167 million in acquisitions, and $568 million of other. So they had a cash outflow of $25 billion in their investing section. In their financing section, they bought back $43 billion of common stock. They paid down $3.8 billion of debt. So they had a cash outflow of $57 billion. This is the equity section on their 331 balance sheet. They have $67 billion of equity. They raised $61 billion from selling common stock, and they profited $13 billion from running their business. Their retained earnings will be much higher if they didn't buy back stock. Every time they buy back stock, it reduces their retained earnings. Let's look at the capital structure. They have $67 billion of equity, $120 billion of debt. They're 36% equity, 64% debt. Their net debt is $68 billion. Net debt is debt minus cash. From 2015 to 2018, they had a higher equity balance than debt balance. But it looks like they added a bunch of debt those few years. Now their debt is higher than their equity. But they do keep a lot of cash on their balance sheet, and they could easily afford the interest payments on their debt. Debt is a great way to grow and scale because it's a cheap way to finance your company. As long as you have enough cash flow coming in to service the debt, it's fine. I use the middle whack on Finbox, 7.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.2 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2 trillion. We divide that by 16 billion shares. And we get a calculated stock price of $125. They're trading at $138, so they're trading at a 10% premium. It's a sell according to the model. The company's revenue target in 2024 is $433 billion. In 2023, it's $416 billion. In 2022, it's $394 billion. And I continued this growth into 2025, and I got $450 billion of revenue. That's how I got their future revenue estimates. They convert on average 26% of their revenue into free cash flow, so I multiplied their future revenue estimates by 26%. That's how I got their future free cash flows. The website Simply Wall Street is at 165. They're saying the stock is 17% undervalued. 27 analysts priced this stock, and the average price target is 188. The low is 160, the high is 210. This is where the stock has been trading the last 5 years. 5 years ago, you could have got the stock for $25 a share. Then it peaked at 200, and it's come back down in the past few months from the bear market. In May of 2021, the stock is trading pretty much where it is right now. So if you bought the stock before May 2021, you should be up right now. But if you bought it after May 2021, you're probably down. They pay a small quarterly dividend. It's 23 cents a share. The dividend yield is 0.67%, which is 15% of their net income, 14% of their free cash flow. But most of their free cash flow goes towards buying back stock, which is another way to reward shareholders. This chart is their dividend yield since 2012. And they used to pay a dividend close to 2%, but the yield has come down a lot because their stock price has increased so much. The forecast is for their yield to be 0.8% by 2024. They have a beta of 1.19, so the stock moves a little more than the market. It's up 8% in the past 52 weeks, while the S&P is down 7%. The 52-week low is 123, the high is 184. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. Over 100 million shares are traded each day. Pretty much all the shares outstanding are on float. 60% are held by institutions, and less than 1% of the shares are shorted. They've done 5 stock splits, a 2-for-1 in 87, 2000, and 2005. They did a 7-for-1 in 2014 and a 4-for-1 in 2020. If you invested $10,000 into this company 10 years ago, you'd have $79,000 today. That's a 689% return, a 23% annual return. The CEO, Tim Cook, his base salary is $3 million and his total compensation package is $99 million. There's only been one insider trade the last 12 months, a sell for 9,000 shares. 54% of the company is held by institutions, 41% by the general public, and 5.5% by public companies. Their employee count has gone up steadily each year. They're currently at 154,000. The biggest shareholder is Vanguard at 8%, then BlackRock, Warren Buffett's Berkshire Hathaway, State Street, and Fidelity. Let's look at their financial ratios. A PE of 22, which is amazing for Apple. That's stock price over earnings per share. Pretty close to the market median of 20, much better than the market average of 30. Price to sales of 5.8, that's stock price over sales per share. Price to book of 33, and a really good price to free cash flow of 21. That's stock price over free cash flow per share. Let's look at their non-current assets. 52 billion of other, 39 billion of PP&E, and 141 billion of marketable securities. Here's a breakdown of their marketable securities. 22 billion of US Treasuries, 5 billion of US agency securities, 14 billion of non-US government securities, 78 billion of corporate debt, and 22 billion of mortgage-backed securities. This is why their debt isn't much of a problem, because look how much they have in investments, 141 billion, which is more than a debt. Let's look at their non-current liabilities, 103 billion of debt and 52 billion of other. Here's a breakdown of that 52 billion, 21 billion of long-term taxes payable. This is how much money they owe the government in taxes, and 32 billion of other. They have an amazing return on invested capital of 70%. They can cover their interest payments 44 times with their operating income. Their ROE is a staggering 151%. Their current assets are a little lower than their current liabilities, so their current ratio is 0.9. Quick ratio is also 0.9. Let's look at their current assets, 28 billion of cash, 23 billion of marketable securities. Here's a breakdown of the cash. Half of that is in cash, 7.7 billion of money market funds, and then US Treasury securities, CDs, commercial paper, etc. Here's a breakdown of the marketable securities. A bulk is in corporate debt securities, commercial paper, non-US government securities, and US Treasury securities. They have 21 billion of accounts receivables. This is how much money their customers owe them. 5.5 billion of inventory, 25 billion of vendor receivables. This is how much money their vendors owe them, and 16 billion of other. Let's look at their current liabilities. 53 billion of accounts payable. This is how much money they owe their vendors. 50 billion of other. 8 billion of deferred revenue. Deferred revenue is when Apple gets paid for a product or service they're going to deliver in the future. 7 billion are commercial paper and 10 billion of debt. They generated over 100 billion of free cash flow in the trailing 12 months. They have negative 9 billion of working capital, and they pay out 15 billion in dividend payments. So the company's really well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 17 companies in the same industry as Apple, and Apple is much bigger than the other 16 companies combined. They spend more on CapEx than all the other companies combined. They have the worst debt to equity ratio. They're the only company that pays a dividend. They generate more free cash flow than the other 16 companies combined. Their price to book is worse than average. Their PE is better than average. Average is 27, they're 22. Price to free cash flow is worse than average, and their price to sales is worse than average. They generate more revenue than the other 16 companies combined. Their 5-year annual revenue growth rate is 12%, average is 6%, and they have a really high ROA and ROE. So to summarize, I have them trading at a 10% premium, And Apple is just a giant of a company. Every time I look into investing into Apple, I think it's too overvalued and too expensive. But then the stock price goes a lot higher, and then I regret not investing in them. So it's one of those companies you really can't go wrong putting your money into. I rank their free cash flows 10 out of 10, their revenue 10 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.